Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. In today's video, we are talking about some fairly exciting news for UK investors. And if you're not a UK property investor, I'm going to give you some good reasons to become one. And I'm also probably going to throw in some tips of how you can become one. But UK house prices have reached an all-time record high, and I want to talk about that data with you and what I think is going to happen in the future. Now guys, before we get into the video, as always, please give this video a big like. It helps me out with the algorithm. Subscribe if you haven't. If you want to book a free one-to-one call with me, I've got nothing to sell to you. All you've got to do is click the link in the description and we can connect one-on-one on Zoom. I'm going to get that out of the way nice and quick so we can get on with the video, and let's start talking about the data. So I'm using the Halifax House Price Index. There's lots of them out there, obviously, but I've chosen the Halifax and we will continue to use the Halifax House Price Index because it means that we have continuity of data. Now, last month, i.e. January, we're looking backwards, remember, the monthly change was 0.7% to the upside. That means that we have an annualized change, January to January, of 3% to the positive, which is good and bad news, right? For myself, I've got about £3 million worth of property. It means roughly £90,000 worth of asset value increase. But during that time, inflation's run about 3%. So it doesn't really mean anything for me in terms of how much money that's created, because in real terms, it's probably about the same. That said, I have leverage, I have mortgages, and because I have mortgages, my own equity in the properties is only 1 million, which means I can multiply it all up by about 3 times. So that annualized growth of 90,000 on my million of equity means that I probably made about a 9% return. Now that does outstrip inflation, and that's why property investing, and I did say I'm going to give you a good strong reason of why property investing is good. Property investing is absolutely insane when it comes to capital appreciation over time using leverage within a secure asset vehicle. Now, there are some things in this report that I want to talk about, and I'm going to look to the left a little bit just so that I can go through that with you. Now, the commentary that accompanies the data states that they believe that record highs have a couple of factors of why that's happening. First of all, people are trying to rush through transactions in order to not be affected by the stamp duty increases. And that probably holds some water, and I think that that's probably true. Now, the second thing that they say is interest rates are starting to come down. Now, if you remember, we peaked at around 5.25%, I think back in July or June last year. We are now down to 4.5%, and every prediction is that interest rates are going to come down over the next 12 to 24 months. Now, what does interest rates mean for the property market? Well, it means that mortgage payments become more affordable. And most people, when they're going out and buying their first home or they're moving up the ladder, are going to require a mortgage. Now, that doesn't mean that all properties in the UK are mortgaged. Absolutely not. In fact, only about a third of them are. You have to remember we have quite an aged population, and within that aged population, lots of people have bought their properties over time and have paid off their mortgages. But people moving into the ladder, and those new buyers and those people who are maybe in their 20s, 30s, 40s, those people tend to still require a mortgage, and it makes the repayments so much cheaper. Now, let me give you an example. I've got about £2 million worth of debt, as I stated earlier on in this video, because I've got £3 million of property, 1 million of equity, must have £2 million worth of debt. Now, my debt servicing payments were roughly around 3% on that if I go back to 2021, about 3%. It currently sits at about 6.5%. Now, that means my mortgage payments have almost doubled. But let's do the maths quickly, and I can give you it in real numbers so you can see what an impact that has on me. Well, 1% of 2 million is £20,000, isn't it? So for every 1% the interest rate moves, it costs me £20,000 a year more. Now, rents have obviously caught up, which means that my interest rates are now affordable. However, it does still mean that I'm making much less profit than when interest rates were lower, even with the lower rents and even with the lower property prices. So, all of that considered, as interest rates start to come down, I'm going to have more liquid cash. And everybody out there who has a mortgage is going to have more liquid cash. Now, what do investors like me do when they have more liquid cash? Well, I'll tell you what we do. We go and buy more property. And the reason we go and buy more property is because we love the asset class, we believe in the asset class, and we can make a good mathematical reason for investing in the asset class. And because of that, the demand will increase from the investor side. Now, if you look at it on the personal side, now let's say, for example, you're a first-time buyer and at the moment you're borrowing at, I don't know, 5-6%. Well, a £100,000 mortgage is going to cost you £5,000-6,000 a year. A £200,000 mortgage, double that. And a £300,000 mortgage, treble that, okay? Now, if those interest rates halve, then the amount that you're going to be paying back comes down. You might think by half, but it doesn't, because most people aren't going to buy an interest-only mortgage. Most investors will, but most residential buyers won't. It'll come down by about a third, or between a quarter and a third, because there's the capital element. But that's a lot of money back in your pocket. Now, let's say, for example, you're going to buy a house and the mortgage is going to be £300,000 at 5%. Well, the interest that you're going to pay on that is going to be nice and easy to calculate, right? 5, 10, £15,000. £15,000 over a year is about £1,250 a month of interest only on a £300,000 mortgage. Bring that interest rate down by half, and suddenly you've got a much more attractive option. Interest, instead of being £1,250 a month, it's going to be £625 a month. So the actual deal and the actual affordability of that property, I keep using deal because I'm an investor, but if you're buying to live in the property, the affordability of that property becomes far more attractive. And at the moment, mortgages and rents are about the same. But historically, with low interest rates, mortgages have always been significantly cheaper. And I believe that that will also increase demand. Now, how fast and how hard will interest rates come down? Look, the reality is no one knows. Everyone's throwing out numbers ranging from 2% in 2027 to about 3% in 2027. So pick your number. Nobody knows. Nobody knows what's going on with the global economy. Nobody knows what's going to happen with the Trump tariffs. Nobody knows what's going on with the wars, the geopolitical factors, fuel prices, where will they be in a year? Nobody actually knows. But the reality is that the Bank of England do have to support the economy. We have rising unemployment, we have low growth or no growth, and we still have inflation. Now, they have to balance this all out, but the reality is they're going to need to protect people's jobs and they're going to need to protect actual growth in the UK economy. And if they don't do those sort of things, inflation is kind of completely irrelevant. Having rising unemployment and low inflation is not actually very useful at all, because you need to have people being productive in order for you to work yourself out of a cycle. So guys, my belief is somewhere between 2 and 3% is probably right. Interest rates will come down. That puts us at about half of where we are now, which will decrease that interest rate payment for myself as an investor by half, but also residential buyers by half. Now, that really does support house price growth. And most predictions are coming out and saying 25 to 35% in the next 5 years. I'm firmly in that same camp. And for me, on £3 million, if we can hit 32, 33%, I will be able to get about another $1 million of equity during that period. And this, guys, is why property investing is so attractive to so many people. It's because you can leverage, it's because somebody else pays that interest, it's because you can have £1 million worth of equity and make £1 million worth of profit over the course of 5 years. And that is how so many people make unimaginable amounts of money out of property investing. Now, I started small, okay, and I said at the beginning of this video, I will give a very good example of how to get started. I bought my first house, £176,000. I rented out for 2 spare bedrooms for about £1,000 a month. My mortgage was $850. I lived there with 2 lodgers who essentially paid the mortgage. I moved out of my rented property, and because at that point, this was my first house, I was essentially netting an extra £1,000 a month into my pocket. And over the next 5 years, of course, that house price increased, went from 176 to about £300,000. I bought in 2010, I know, very lucky, but trust me, at the time, everyone was telling me this is not a good time to buy. I was very lucky to buy when I bought, and I was very lucky with the outcome. But the reality is I could have bought a year later or a year later, and I would have still been okay. So the one thing it did teach me was the earlier I got started, the more money I made. And I would say right now, At any point in the past, I wish I'd bought more property. It's record highs. Of course I do. I would have made more money. So guys, let me know in the comments what your thoughts are. Record prices, should we be buying? Interest rates coming down. Is that going to support more growth? I believe so. I'll see you on the next video. Like and subscribe. Cheers, guys.